Annual tax return. Why is the annual tax return more than a year-end formality? In Mexico, the annual tax return is the point where all tax activity throughout the year is consolidated and validated by the tax authority. It is not a simple closing exercise, but a comprehensive reconciliation of income, deductions, tax credits, provisional payments, and compliance positions. Any inconsistency accumulated during the year becomes visible at this stage. What information is consolidated into the annual tax return? The annual return consolidates taxable income, authorized deductions, payroll costs, depreciation, tax losses, provisional income tax payments, withholding taxes, and tax credits. It also reflects the consistency between accounting records, monthly returns, electronic invoices, CFDI, and informative reports filed during the year. How do errors throughout the year surface in the annual return? Errors that may seem minor monthly, such as incorrect invoicing, misclassified expenses, or VAT inconsistencies, accumulate over time. When the annual return is prepared, these discrepancies surface through reconciliation differences, unsupported deductions, or mismatches with third-party data reported to the tax authority. Why is the annual return often where risks become visible? Because the annual return is subject to deeper analysis and cross-checks by the SAT. It provides a full-year picture that allows the authority to identify unusual patterns, aggressive tax positions, or inconsistencies that may not be evident in monthly filings. As a result, it is a key audit trigger. What are the most common red flags in annual tax returns? Common red flags include significant variations in taxable income, high levels of deductions without strong support, repeated tax losses, inconsistencies between accounting records and tax returns, differences with third-party information, and large tax refunds or credits without a clear economic explanation. How far back can an error in the annual return affect the company? In Mexico, errors in an annual tax return can affect multiple years. The tax authority has the power to review prior fiscal years within the statute of limitations, and an issue identified in one year often leads to a broader review of historical filings, increasing cumulative exposure. How should companies prepare long before filing season? Companies should prepare by maintaining clean accounting records, ensuring CFDI compliance, performing periodic reconciliations, reviewing tax positions during the year, and identifying risks early. Proactive tax reviews and internal controls reduce pressure, surprises, and corrections at year-end. Learn more about tax compliance in Prudenza Academy. Built for strategic execution.